Hello and welcome to Chapter 2 in Tax 1. In this chapter, we're going to expand upon the tax formula, talk a little bit more about Form 1040 and some of the very basic concepts of 1040. And as we dig deeper into the tax formula, we see that we have schedules now that are a part of the basic tax form 1040, and a hallmark calculation and concept of individual tax returns is the adjusted gross income, and we'll talk a little bit about that. The basic calculation for AGI is the gross income less any permitted deductions, and we'll start the conversation about some of those deductions, but there'll be much more to come regarding deductions and credits in the future. As you can see, we've expanded now the tax formula where we start at gross income again, and now we're going to deduct permitted deductions from gross income, and we arrive at our adjusted gross income. Again, this AGI number is unique to individual federal taxation. Then we'll take out either the standard deduction, for example, $12,000 for a single person, or itemized deductions if this amount exceeds the standard deduction. And finally, we'll arrive at taxable income, and then we'll multiply the taxable income times the appropriate tax rate, and that is the amount that we owe the IRS that year. That is our tax liability. From that liability, then, we can deduct credits, other taxes, and any tax payments or refundable credits. Example of a tax payment, again, is the amount that we had withheld from our payroll checks. Finally, we arrive at the tax refund or tax due with the return. So just to review, when preparing a tax return, you will seldom use any of the schedules. That is false. It depends upon the complexity of your tax return, but the more complex, the more likely it will be that you'll use more schedules. The concept of AGI is important because many deductions and credits reported on the tax return are computed based on the amount shown as AGI. Absolutely. We want to try to get our AGI number for purposes of credits and deductions as low as possible. So if there are any deductions for AGI, which we'll talk about later, for example, making a contribution to a qualified traditional IRA, that would reduce your AGI and may qualify the taxpayer to take more deductions and credits. So just to step back a little bit, let's take a look at the 5 filing statuses in the Federal Tax Code. One is single, where you're not married as of the last day of the year. So if you were married, for example, on December 30th of the tax year, then you would be considered married all year. Married filing joint, very common and can be advantageous for taxpayers if they are married. Must be legally married as of the last day, as we said. What is marital status, or what is a married couple? The IRS defers, and the Congress, to be more precise, defers to the state of the taxpayer, and then they would define what being married or being a couple is for tax purposes. It doesn't matter if only one has earned income, of course. So married filing separately, often this can be disadvantageous. In most cases it is for married taxpayers, but there are occasions and situations where married filing separately can be advantageous. So it must be married but elect to file separately in order to achieve this status. Standard deduction can only be taken if both take the standard deduction. Must show the Social Security number of the other spouse on the taxpayer's return as you would if you were married. And as I said, it would have to be an unusual situation for a married couple to file separately and pay less tax with that filing status. Another filing status is head of household. Here the person is unmarried as of the end of the year. A married taxpayer living apart from the spouse during the last 6 months qualifies as unmarried. Must be U.S. citizen or resident, maintain a household for a person for more than half the year. So, for example, parents can often live in separate households, but one may have the qualifying child, for example, and the qualifying child then would provide potential for this taxpayer to claim head of household status. And by the way, head of household filing status generally provides a greater tax benefit than filing single, as long as the taxpayer qualifies. Another filing status is the qualifying widower with a dependent child. So if a person, and I should say widow or widowed, depending upon the situation, this is permitted for 2 years, and this is a nice benefit for someone who's lost a spouse and has a dependent child. They can file as though they were married for the next 2 years. So in addition to the year of the death of the spouse, there is an additional 2 years where that taxpayer can get the benefits of married filing joint by filing with this status of qualifying widow or widow. Okay, so to qualify for the status, you must pay for more than half the cost of the household that is a principal place for usually a child for the entire year. There are cases when temporary absences are permitted, such as if the child is going away to school. So just to review, even though you are in the process of getting a divorce, you can file as married filing jointly, and the answer is true. As we talked about, as I mentioned earlier, the Social Security number of the taxpayer's spouse must be shown in the taxpayer's return. They're filing separately, and the answer is true. So if a Social Security number of one taxpayer is listed on the return when they're filing separately, they must also include the other spouse's Social Security number. And that is true of both spouses. Surviving spouse who qualified as married filing jointly, when the spouse died, can file as a qualifying widower for the next 2 years as long as the surviving spouse pays for more than half the cost of keeping up the household and does not remarry. This is false. So if we look, surviving spouse, that the first part is fine, who qualified as married filing jointly. However, the third line, it says the qualifying widow or widower for the next 2 years as long as the surviving spouse pays more than half the cost of keeping up a household and does not remarry, and would have to provide more than half the support for a dependent, usually a child. The dependent must be a qualifying child or relative and meet the 3 general tests. So the dependent taxpayer test, if the dependent can be claimed by someone else, then that taxpayer cannot claim this person as a dependent. The joint return test, a person claimed as a dependent cannot file a joint return with his or her spouse unless the return is filed only to claim a refund and there's no tax liability due. So this is kind of an exception where if a couple is married, they can file a joint return if one of them is being claimed as a dependent. Normally you cannot file if you're being claimed as a dependent, but in this case you can file as long as the reason for filing is only to claim a refund and the filing results in no tax due by the taxpayer. Citizen or resident test, the dependent must meet one of the following. So in order to claim someone as a dependent, they have to be a U.S. citizen, resident, or national, or they could be a resident of Canada or Mexico, or they could be an adopted child of the taxpayer if the child is a member of the taxpayer's household all year and the taxpayer is a U.S. citizen or national. We're looking at the relationship test. That is one test of 5 that must be met in order to have a qualifying child claim as a dependent. The relationship test, of course, it could be the child or a descendant of the child, such as a grandchild or great-grandchild, stepchild, foster child, for example, brother, sister, half-brother, half-sister, stepbrother, stepsister, or descendant of them would qualify as a child. Age test, you generally have to be under 19 years of age or under 24 if you're going to school full-time. The residency test, the child would have to live with the taxpayer for more than half the year to meet this requirement. And as I said earlier, temporary absences are permitted. And the support test, the child must not provide more than half their support. And then a special test for qualifying child of more than one taxpayer. Here, this comes up sometimes with married or formerly married couples that are now divorced. And they're negotiating to see who can claim the child as a dependent. There are some tests listed in the text that you can look at to determine who would be able to claim the child when more than one person provides support. For example, if only one of the person is a child's parent, then that because they're the parent, they would get to claim the child as a dependent and then get the tax benefit. So just to review, what are the 5 specific tests you need to meet to claim someone as a qualifying child? We talked about the relationship test, age test, and residency test, as well as the support test, and then the special test for qualifying child of more than one taxpayer. To meet the age test, a child who is not disabled must be, as I said earlier, under 19 or under 24 and a full-time student. If the child is a disabled child, then oftentimes this age requirement is waived. Also, for years after 2008, the child must be younger than the person claiming the dependency. Before 2008, that was not the case. But now this is another requirement. In the next video, we'll finish up our discussion of Chapter 2 and address one of the Connect assigned problems.